Welcome, everyone. I'm Keith Schaefer, writer, owner, editor of InvestingWhisperer.com. I'm here with Jonathan Lansky, former sell side, former buy side, current blog writer at No Straight Lines Investments for the last couple of years. We have an interesting investing thesis for you today. It's only going to take about 7 to 10 minutes to share it with you. And I think you're going to find this a little outside of the box for both our audiences. Jonathan, thank you so much for joining me today.
Pleasure to be here, Keith. Thanks for having me.
And so we have all been very focused here over the last few years on the energy transition out of oil and gas into different forms of electrification, whether that's solar, wind, and a lot of that time has been spent in some of the small cap ideas. But you have a large cap idea that makes a lot of sense, and there's a lot of points that you're going to bring up today in this very short time frame to kind of bring it home to investors. And I've got a few charts that we're going to be able to pull up along the way. And this really involves utilities, which has generally been a bit of a ignored sector by retail investors, but you think has a possibility of providing some outsized gains here. And so why don't you kind of give us a couple ideas here on why this has come across your radar screen and what you think is going to continue to drive this idea?
Sure, happy to do it. I think I'd begin by saying the major reason it's off most people's radar screens is the simple fact that the utility sector is 2% of the S&P 500. So by definition, anybody who is tied to an index, closet indexing, however you want to put it, is simply not interested because it's not going to change their performance one way or the other. The second thing, obviously, that has worked against the utilities is higher interest rates. Higher interest rates, by definition, are not good for businesses that are generally owned for their yield, right? That's just the way it is. And I think the most important thing that's different this time is these stocks have historically not exhibited high levels of growth. And so, as we all know, where we stand today, there is a fascination, obsession, whatever you want to call it, with growth. And of course, that's because the performance has justified that. And so, why don't we pull up this first chart? So this is Vistra, merchant power provider. Obviously,
that's an amazing chart.
That's a pretty attractive chart. Yeah, exactly. Let's just call it what it is. And we could maybe pull up Constellation as well, CEG. And you can see that it's got a very similar looking chart. Just wait for it. Yeah, same idea. And so you ask yourself, why is this happening? And I am not the first person to bring this up. This is a theme that has been percolating in the background. I would argue that it's somewhat hidden in plain sight. So all of the big brokers, JP Morgan, Morgan Stanley, Evercore ISI, have written documents in the last month highlighting the surge in power demand, which is going to be mostly a function of the boom in AI centric data centers. But it's more than just that. That's the one that everyone's focused on. But the electrification of everything is what's driving this, Keith. So it's the reshoring. I think there's something like $480 billion of infrastructure projects have been approved since 2021. Factories, these are things like the CHIPS Act, the IRA, the Inflation Reduction Act, have led to a boom in construction of factories in the US. The second thing we all know about EVs. And so all of those charging stations, all of the charging is incrementally new electricity demand. And I think the final point is, outside of the data centers, is that buildings, commercial buildings mostly, are being converted from the use of fossil fuels for their HVAC needs to heat pumps. And so combine that finally with this dramatic boom in AI powered data centers. And these data centers, just to put the perspective on things, an AI rack in a data center consumes up to 7 times more power than a conventional data center. And so, you don't need to be very good at math to understand that, the quantums in increase in power demand are enormous. And so this is
Well,
not a,
even at the
go ahead.
retail level, they say that a Chat GPT search is 10 times the energy and power than a regular Google search.
Correct. Exactly. And so, and by the way, needless to say, this is not a, 6-month or 1-year theme. This is decade plus uh, theme. And I think probably the final thing I'd say here is, well, first of all, don't take my word for it. Larry Fink this morning said, AI cannot happen without investment in energy infrastructure. I would put it even more simply. If you believe these forecasts for growth, starting with, NVIDIA as the poster child, right? If they're selling all these AI chips and we take that as a given, if we take it as a given that Amazon, Google, Meta, Microsoft will be investing in the AI infrastructure, which they've said they will, then that can't happen unless there is a dramatic increase in the investment required to provide the power for these data centers, et cetera. And so that's why you're seeing charts like Vistra. That's why you're seeing charts like Constellation Energy. And that's why I think you should be paying attention.
So this really is very much an AI derivative play. As you say, there are many factors that are going into increased energy load, the whole energy transition thing that's been going along. But when you look at this Vistra chart, like it was flat as a pancake for years, and then just took off like Q1 last year. So again, December 22, everybody was on discovering Chat GPT on their phones. Give that a 3-month lag to kind of really catch fire. Is that a pretty fair approximation of why this chart took off when it did?
I think so. I think I think the real canary in the coal mine, of course, was Nvidia and the explosive growth that they have witnessed. And make no mistake, it's real. And so, once that happened, people started to look around like they always do. Okay, so what are the plays? So you've had, you could look at industrial stocks like Eaton Corp or Vertiv, which is one that I owned, sold it at $50 like a genius, and now it's 85. But they are key beneficiaries of the infrastructure that's going into these data centers. Like Vertiv, for example, does liquid cooling, and all of the new AI architecture runs extremely hot, and so it's going to need liquid cooling, just as an example. But at a more basic level, they need gobs of electricity, and so again, it's not necessarily a new idea. Clearly, looking at these charts, you can see that. But my basic premise is that the demand for electricity in the US was essentially unchanged or, moderate growth for 20 years. And the reason was that population growth, economic growth was offset by efficiency gains. And so now we're at a point where we're seeing a hockey stick in relative terms in energy demand. You can pull up maybe that load growth one, Keith, this is just a load growth graph from the NERC. And I suggest it's probably out of date because this was about a month and a half ago. It was in the, bless you, in the Financial Times. They wrote an article on just what we're talking about here. And it shows a 10-year project forward. So 2024 would be 2024 to 3033.
Mm-hmm.
Or sorry, 2033. Pardon me, getting ahead of myself. In any event, yeah. So,
and then you want to talk about so obviously we saw Vestra and Constellation as merchant power suppliers, IPPs, independent power producers. Their stocks just took off like a rocket. You're suggesting something now, obviously, after those kind of gains, that those charts are pretty tough to buy. You're suggesting that investors might want to have a look at the utilities index, XLU?
XLU is certainly an option. The biggest component of XLU is the name that I own, which is Nextera Energy. But for sure, you could get a more diversified basket of stocks buying the XLU. Nextera is attractive to me because they have the regulated utility, which is Florida Light and Power, or Power and Light, I think, FPL. It's the biggest electric utility in the U.S. and the biggest driver of growth in regulated utilities is population growth, right? And Florida has obviously got significant population growth. But the part of it that's exciting to me is the Nextera Resources, which is the renewables business. It's the largest renewables business in America, 20% market share. And the reason that matters is what I think is going to really matter in the next 5 years is speed to market, right? The biggest problem with the energy grid right now is there's a massive queue of projects, and the biggest governor of getting those projects on grid is what they call interconnection. I'm sure you've heard of that. Nextera happens to have a massive bank of interconnection. You could call it it's basically a competitive advantage, right? Because they can tap into these. They basically have a reserve spot in a line, and when they find the project they want, they jump to the head of the line and they bring the project online. So they can bring wind and solar projects to market faster than anybody else because of their scale. They have advantages of cost, and so they get better returns. And to use a recent example, a few months ago, Amazon signed a deal with a company called Talon Energy, and they paid 100% premium for 10 years of power. So if that is a benchmark for where we're going,
A sign of things to come.
yeah, I think it's inevitable. I think just generally speaking, electricity prices are going to go higher because this demand is unprecedented. And so I think that's number one. So I believe, again, back to the XLU, all of these companies are going to benefit from a tailwind in that respect. But number two, if you've got the ability to bring projects to market faster, you are going to be a partner of choice. And that's why I think Nextera is really interesting. By the way, just because it's, worthy of mention, they have grown their earnings at a compound annual rate of 10% over the last 10 years. So it's not like this is a junky story.
Yeah, well, that's certainly what that chart says.
Yeah, it's an excellent company. I just think the jewel is the renewable side. And by the way, so they have a 20 gigawatt hard backlog. 3 gigawatt of the 20 is data centers specifically. And I think that number is going to grow dramatically over the next couple of years. It'll be really interesting what they say on their conference call, which they report on April 23rd. So definitely be paying attention.
Coming up very soon.
Yes.
And even when you look at this chart, so it bottomed here when rates blew out in late October, and it's slowly come back. Even as we've kind of seen the prospect of lower rates get pushed farther out, the stock's gone up.
Yes. Yeah. I think they hosted an analyst day. Nextera Resources did, not at Nextera Energy, the parent co, the renewable side of the business. And what they really gave in terms of reading a bunch of analyst reports post is that analysts came away a lot more comfortable in understanding that these guys are the leader, that they've got a real advantage in terms of, because at the end of the day, you would imagine, Keith, like anything else, just like in the energy business, guess what gets used up first? The best locations, right? And so in figuring out where to put a wind farm or where to build a solar farm, the best locations, needless to say, have been already taken. So you need to look a little bit further and a little bit wider to find the next best location. But it's clear that Nextera, because they've been in this for 20 years, and they've got more data than everybody else, and they literally force rank locations every single day so that if, Google comes calling or Microsoft comes calling, here you go, guys. Here's the best site with all the attributes you're looking for. And that to me is and by the way, we can bring it online in the next 12 months. That's pretty compelling.
Yes, indeed. So getting permits and is key in any resource. Doesn't matter whether it's
Correct.
mining,
Yeah.
oil and gas, electricity. It doesn't matter. It's
No.
become even more important to the market than the actual resource itself.
The biggest, if you look at the renewables space, it's easy to conclude, of course, that, interest rates were the main culprit, and they were for the, delay, if you want, the lack of progress on, moving projects forward. But hidden underneath that, like I said, the biggest problem is interconnection, right? Everything makes sense, but we can't connect it to the grid. For the delays are enormous. We're not talking, 5 months or 3 months. We're talking like a couple years. At which point, you would imagine some of the parties would lose interest. Not to mention if they're carrying, if all of a sudden the carry went from 0% to 5% interest rates, that becomes a big problem.
Oh yeah, big time. And so you're seeing that with some of the smaller developers right now, where look at what happened in Alberta, where they opened their arms to all these renewables, then had to kind of shut the door for a bit before opening it again. And when you're a small
Correct.
company, that's tough. But when you're a big company, you've got the staying power to make that happen. And Nextera is clearly that.
Yes.
So just to wind up, Jonathan, you want to just recap some of the decade-long drivers behind this trade that you think is just giving it the perfect setup?
So yeah, I mean, obviously we'll start with data centers, and again, I would just say the numbers keep being revised up. So last year, McKinsey was projecting that data centers would require 35 gigawatts of power by 2030. They just published a new number; it's 50 gigawatts. So
Yep, huge,
uh,
huge increase.
huge increase, huge increase. So that's number one. Number two, like I said, is the reshoring theme. As we all know, supply chains got significantly disrupted through the pandemic. And as a consequence of that, everyone decided that they needed to have production closer to home. They didn't want to be reliant on something that had to travel across the ocean from a different country necessarily. And so that's not changing anytime soon. As I said, the mainly the CHIPS Act, but also the IRA have created a massive surge in onshoring, and that creates demand that wasn't there before. Third thing, which again, it's a thematic. I understand people are less bullish on electric vehicles today than they were 6 months ago, but the reality is they're not going away. And so that will continue to be a demand driver for electricity. And the final one, again, very, very important, which is the electrification of buildings. All of these giant office towers and commercial buildings, for the most part, are heated and cooled using fossil fuels. And so that's going to change over. It is changing over. It will continue to change over to heat pumps, which are electric and create obviously a dramatic bump in demand. And so those are the themes. I don't think they're going away, and that's why I think it makes sense to allocate a little bit of capital, or at least have a look at the utilities. Obviously, do your own work and decide. But that's where I've come out, and that's why I own Nextera.
Okay, awesome. Thank you so much. So
Thank you, sir.
Nextera is a much larger cap company, and the reasons here that to look at this one is because of its renewable backlog and its ability to get projects into production very quickly.
They have I called it, when I wrote about it in my blog I don't know, it was about a month ago. I called it a double dip on AI, because obviously there's the known, which is the the power demand, which they can meet with their renewables. But the double dip is they use AI extensively. As I said, they have more data than anybody else on renewables through a series of sensors. They have wind sensors. They've got solar radiation sensors, and they literally have a massive suite of software programs that crunch this data on a by a minute basis, and it gives them a competitive advantage in terms of citing their next renewables project. So I
And
think that's why, yeah.
just out of curiosity, what's the current yield on the stock?
It's like 3.5%.
So
And the payout's conservative. It's a 60% payout. Their purpose preference, if you will, seems to be to just grow it steady Eddie as opposed to crank up the payout. So they've, again, just along with the earnings growth, they've also grown their dividend 10% a year over the last 10 years. So
awesome. Awesome. So everyone can see here on the screen, No Straight Lines Investments. It's a blog. If you Google it, you'll be able to sign up for his free portion. And if you like what you read after the first couple of times, you might want to sign up for the paid one, which is only $20 a month. Correct, Jonathan?
yes, sir. Yep.
Awesome. So Jonathan, thank you so much for joining us today,
Thank you,
and
Keith.
look forward to doing a follow-up here in the next couple of weeks in the next several weeks after we see how everything goes.
I agree. Thank you very much for having me. Really appreciate it.
All right.
Have a
God
great
bless you.
day.
Cheers.